So tell me now, I mean, of course, from your vantage point, you've seen so many bear markets, you've seen so many bull markets, so you know how to kind of time it, right? But so many people who they don't have the research capacity, they don't know how to time markets, but they want to invest. So in this phase, what should one do?
So in this phase, it's very clear that SIP is obviously a popular product. I'm not convinced it's a great product. Okay. I believe, and I have data to back it up, but I will not discuss it on this show, maybe the next one.
No, please do. I mean, I'm
no,
happy to
I
hear that.
I'm still forming that. I'm going to write a piece on that. That basically a staggered lump sum approach is better than an SIP.
Okay.
Meaning that you still, irrespective of what anybody tells you, markets are cyclical. When they are cyclical, and at the bottom of the cycle, when you realize that the returns in that lake are very, very low, you should put more money then rather than wait and come in at the top even through an SIP. Because what happens is very important. SIP is an equal amount of money injected into the market from your account as the market is climbing up. What happens is that you've not taken advantage of the lows. Your averages...
Disproportionately.
Your averages tend to keep creeping up to be maybe 15-20% away from the top. Now think about that. Once you've done that and the market's correct 20%, you're zero. The whole bull market for you has evaporated. It's gone. It's finished.
But dollar cost averaging is a method that has worked for years, right? I mean,
where has it worked? It's worked in the US. And again, I'm saying longer durations of bull market is where the dollar cost averaging or the SIP works. Shorter duration bull markets, it does not work because by the time you got sizable money in through your SIPs, the market is already peaking. And your averages are then caught up with the peak of the market. So just a 20% fall makes your entire profit of the whole bull market cycle go. Another 5-10% you're negative. You say, yaar, maine 5-6 saal kiya ye, net mujhe kya mila? If I had put money into FD, nothing but return of capital is assured. Plus 7% on that is, or maybe 8% in a good NBFC, Bajaj Finance 8%. Minus tax, but now tax in the equity is also similar to that of tax on the fixed deposit. Earlier that was not the case. Okay. Tax was a big difference between fixed income and equities. But now you have decent amount of tax on even equity returns. So why go through all this janjat? You see, that's the question SIP forces you to ask. So my view is that it is better, I don't know how it gets implemented by people, that lump sum staggered into 5-10 tranches is a lot better than slicing it into 200 tranches. So
lump sum, when you say into what? Into large cap stocks, direct equities, or through mutual funds?
If you're talking an average person, he doesn't have the tools, he doesn't have the understanding, not even the time.
Doesn't have the time,
No time, okay? And by the way, experience. Okay, none of this wisdom was there with us for 35 years ago. It takes experience to figure out all these things. So for that person, the right way, in my view, is to really speaking, get into markets when return levels or the water levels have become so low that they cannot go any lower. For example, 2015 to 2020, the lake of returns was only 1% CAGR.
Wow.
From 15 to 20, like now.
For 5 years.
5 years, 1%. Go and check the data. Nobody now remembers this. But I am a person of my data ka keeda hu.
But 2020 में तो बड़ा crash आया था ना?
Correct. So I'm saying.
तो तब तक तो market had gone up.
No, go and check it. Go and check it. See, that's the point. We believe in our brain conditions as to think, markets are always good. No, they were not. For 5 years, we had a barren patch. The lake returns,
in mid and small caps, you're saying? Or
aggregate.
In aggregate.
CAGR was 1% from the market returns. Mid caps, small caps were negative in 18 to 20. Yeah. Averaged out 1% CAGR. Lake returns and the lake waters were very low. It was due for a rally. That's a time when you should put sizable money into the markets. That's why the lake of returns theory is so powerful. It gives you the ability to time the cycles. It doesn't have to be perfection. Even if you're plus minus 1 year, you're good. But SIP, because of the very nature of this average, gets you to splice your capital into small tranches. By the time you 3-4 years are over, you're near the peak, and your averages are 20% below the peak, or something like that. And 20% correction wiped out 4 years of hard work. Which is precisely why you might say markets are fallen only 20%. But they have gone up so much. Yeah, they have gone up, but you were not invested all of it or nearly all of it at the bottom.
At the bottom. So is this the bottom?
No, I don't think this is the bottom.
So this is not the time to make that lump sum investment.
I think it's too early to start thinking of that.
Okay.
It's too early. Let the lake waters recede some more. Understand this point also. People will say, no, but in COVID it recovered in 1 month. Okay? Yes, it did. But what was COVID? COVID was an exogenous event. It was like a equivalent of a nuclear war or whatever it is. It was a global problem. So when there is something that is causing a bear market which is global, everybody gets interested in solving that problem. COVID, all the world's laboratories, all the global central banks, everybody coordinated to find a solution. Hence, the solution came within a few months.
But don't you think this is also kind of like a global problem where the entire globe is now dealing with slow growth, high inflation, high costs, unemployment? I mean, you talk about any area, unemployment has gone up, costs have risen, growth is slow.
That is permanently the case. Some problem will be there. But look at the markets. Barring India, no major market has fallen as much. Please understand this. I mean, Asia has been doing pretty well. China, of course, very, very well. Europe has been an absolute blast out. Okay,
Even the US.
US was very good till about maybe 15, 20 days ago.
Yeah.
Okay, still down only 6-7%, not like down 25%. This is our local, personal, warm, cuddly bear market. This is not a global bear market.
You tweeted about that. You said this is 100% local.
It is purely
issue.
local.
Yeah.
Globe is not interested in solving your problem. You have to find your solutions. GFC was a global problem. The world solved it. Everybody coordinated. .com was a global problem. Tech was crushed worldwide. The central banks, especially in the US, they came out and solved the problem. Okay? Harshad Mehta was a local problem. We had to find the bullet. We don't have bullets. It took 7-8 years to work its way out of the system. We have a similar. I'm not saying it's going to take 7-8 years. All I'm saying is local problems require local solutions. I don't know what solutions we have right now.
So what is the big problem locally, you think? Earnings growth.
Earnings growth.
Slowdown.
Exactly.
Consumption.
Okay, it's very simple. Again, some bit of data. We had very, very poor GDP growth from 2015 to 2020. Again, you will not believe it, but the data was 2019-20 GDP growth. Do you know what it was?
No, 5-6%.
4.4%.
Okay.
You can't believe it, right? 1920, 4.4%. COVID came.
After that, it must have fallen further.
COVID was 1 year was very bad, but then we picked up dramatically.
Yeah.
Why? Capex. Correct? Government rapidly increased the capex. The same government which had not done that level of capex in the preceding 4, 5, 6 years suddenly found the magic bullet in capex. So capex numbers kept shooting up 5 lakh, 7 lakh, 10 lakh, 11 lakh crores. Now there is a finite level of capex you can do. Now the market has gotten used to, it's like a steroid shot. First time very good result, second time little less, third time little less. Sixth year you need more shots. You don't have more shots. 11 lakh crore is your ceiling of capex. It cannot go. If anything, the bias would be to have it lower because you have a revenue problem. The revenue problem is taxation. Again, this is very important. Again, pure data. There's no opinion here right now. We have two, on the direct tax, two predictable sources, corporate income tax and personal income tax. Corporate tax was reduced in 19. Personal income tax now. What has increased in the direct taxes? Capital gains tax, STTs. So now you have a pie chart in which you have gone from predictable sources of tax revenues to a hugely volatile, highly unpredictable sources of tax revenue, which is stock market. So you have stock marketified the revenue pie chart away from predictability to a highly unpredictable level. Now, does anybody seriously believe we are going to get 2 lakh crores in capital gains this year, 25-26? No chance.
In the bull market, maybe that was possible, but now
we got that. 23 was 1 lakh crores in long term, maybe 50,000 crores in short term, maybe 40,000 crores in STT. So that's about 2 lakh crores. In 24-25, we don't have the data, but it could have been double that figure. So you're looking at 4-5 lakh crores coming from the stock market related income tax. Does anybody seriously believe these numbers are going to be achieved in 25-26? Not a chance. The problem with capital gains is you make capital gains, you book it and you pay it. Now when there is a capital loss, you get a 6-7 year carry forward and a set off period. So now whatever losses you're booking now, you have 5-6 years of window. So it's not only next year's numbers that are in jeopardy, it's also subsequent years. Till you recover these losses, which means markets have to go up dramatically up, for you to break even. So for that period, what does the government bank on? You see the problem. The problem is our revenues are now very, very stock market driven. I am uncomfortable with that. It has never been the case before in our fisc.
So what is the impact that all of this would have on, so of course we're talking about, now there's so much chatter about bringing down the capital gains tax and all of that.
No, it's not going to come down. Forget it.
Yeah.
It's not going to happen. Impossible. Because you bet your house fisc on that. If you reduce that, then you have to cut back on capex.
Yeah.
Right? If you cut back on capex, you cut back on growth. But I'm saying this is a fait accompli. You will have a shortfall on the direct taxes on the personal part because of the capital gains not being there. And it might have a shortfall of maybe 1 lakh of crores, 1.5 lakh crores. Versus that, you will have to cut back because the fiscal deficit is 4.4% target. They will not miss that. So where will they adjust it? Only in capex. So if 11 lakh crores doesn't happen, you go to 10 lakh crores, 9.5 lakh crores. You know that is the needle that has moved the GDP number. That means you're looking at a slowdown in growth. It might be like 5% growth. We are already struggling to meet 6%.
Yeah.
Okay? It's a struggle now. 5% can be very
even
important.
X of capex, right? There's a huge consumption slowdown in semi-urban,
Precisely.
because of inflation.
And it's just that a lot of the gains came from the stock market or the consumption. That's very important. And there's something which by the way, in 2008 there was a conference and I addressed a conference, it was a Financial Times conference. I said that I am against the whole concept of over-ownership in India of equities. It's good for the West to have 70% ownership of equities.
Explain that to me. Over-ownership of retail?
By retail of equities.
Okay.
The West is okay. They have social security, they have safety nets, they have free medical, blah, 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 blah. So they can take more risk. And plus, they're richer. 50, 60, 80,000 dollars per capita. They can take risk with their investments and their capital in equity markets. India is $1,000, $2,000, $2,500. You have no safety net. If you fall ill, you have to go and pay. You can't go to government hospital. Education, you can go to government school, but would anybody send their kids? No. There's no social security. With that capital, you're going to ask people to put money into equities. It's ridiculous.
Which is very risky.
Very risky. So I had said that, very controversial back then. But today you're seeing that exact same problem that people have rushed in. They thought equity markets were not cyclical. They thought returns were guaranteed. All the marketing machine of the finance industry, Twitter, etc., you're there on that, is all about just putting more and more capital in. Now, when that has gone, the returns evaporated. What will happen?
Yeah.
You will cut back on consumption.
In fact, you tweeted about that as well, right? What would the effect of the erosion of wealth because of the capital markets going down? There is this whole erosion of personal wealth that's taking place. What will the effect be on consumption?
Exactly. And I got very interesting replies. Many people said that I was planning to buy an SUV, home purchases have been deferred, holidays have been deferred. It will happen. Now, forget the fisc. Even the consumption has become stock marketified.
Yeah.
So fisc is dependent on this silly thing called stock market. Consumption is dependent on this silly thing called stock market. What kind of economic pie have we now made? Yeah. So I'm against the stock market pervading so closely to people in Jaipur and Bhubaneswar and all that. It's all good. Fort, BKC, Nariman Point, Delhi, Gujarat, or Calcutta. 7-8 cities का market होना चाहिए. बाकी को दूर रखो, put money in FD and live life happily.
Do you think you've got a more clearer picture of what's happening after you moved out of India? Because, when you're sitting here, and I ask this question a lot, I feel like when you're sitting in India, you tend to overhype or, you become a hype beast of the so-called
echo chamber
growth. Of course, it's an echo chamber. But do you think once you've stepped out, you've actually seen what the reality is? And is it very different from what we live? Like, everyone is saying, oh, the big growth stories in India, etc., etc. But when you go out, you realize that India has a lot of work to be done.
I met a fund manager recently, an old friend of mine, and I was having a cup of coffee. He said, yaar, what's wrong with you guys in India? This is before this current crash and all. This is like middle of last year when market was still good. I said, why? He said, I'm in New York. There is no such big talk about India being the next superpower and biggest growth story. It's okay. It's one market. There are many markets, many asset classes, I said, yeah, but we are in India. India is a closed chamber, and we just, echo the same story
Yeah.
through TV, through media. And the other thing very interesting about India is the being closed is not just about, the markets. It's about the news. The media does not help in propagating larger perspectives of markets. Like even last year, 24, India was the 20th worst performing market. 24. Forget the current crash. Did you ever hear it on TV? Did you ever hear it in print? No. It pays us to keep the
Growth story alive.
growth story or the myth of permanent bull market alive.
100%, yeah.
That's the way the game works. And average guy doesn't look at, Bloomberg and all that and Reuters to see, oh, okay, other market is doing better. So we have cultivated a generation of investors who are literally brainwashed into believing that we are the only game in town. We are, but we are only cyclically so, not permanently so.
100%, yeah. I mean,
Don't look so worried.
No. All the young guys sitting here are like, Abhi mera kya hoga? Every time you come, you give me a lot of stress, Shankar, talking about the problems
this is
in
data,
India.
Baba. This is data. This is not problem. Once you admit and accept there is a problem, you have solutions.
Yeah. No. I completely agree with you. But okay, now, I just playing
It's like a doctor. You go to a doctor, you say, "Arey, sab kuch theek hai. Aapka BP thoda high hai, 150 by 100, but it's okay. At this age, it's all what rubbish."
First, you need to acknowledge that there is a problem and then address it.
Correct.
So
If I'm in this business of wealth, as opposed to the business, as also the business of health, facing the truth helps. Data talks. Your blood report will show you the picture. You ignore it. It's up to you.
Yeah.
Do you want to ignore the data? Many people ignore the data. Cholesterol abhi 400 hai. It's okay, kam ho jayega. What are you doing? But no, I'm really relaxed about it. I visualize that my cholesterol level is going to come down. I've got this Rhonda Burns in my head. What rubbish is this? Do something. It's the same principle in wealth. What works in health is data. What should work in wealth is also data.
You've gotten into health in a big way, at least.
Yeah,
right?
because I believe that the best years of your life are when you spend 30 years in the market, you turn 55, 60, you got the wisdom and the experience and the scars to prove that 35 years, then your best period starts. But if at that point, you've got high BP, you've got cholesterol, you can't walk, you can't sit, you can't eat, you can't drink, and maybe you drop dead, it's not worth it. If this period is like literally your middle overs of life, if you bat out these overs, you will become seriously rich and you'll be ready for the slog overs.
Yeah.
Most people get out at this time. So health for me is more important than wealth, for sure.